There's one concept that 99% of traders keep on missing. Most traders continually give their hard-earned money to the markets, while a small minority consistently extracts profits. Look, it's not like I haven't been there. I've blown prop firm accounts, lost personal accounts, chasing trades, winning one day but losing it all the next day. And after I became a multiple six-figure funded prop firm trader, I understood that it's not about strategy or indicators. It's about the thing that I'm about to teach you in this video. So right off the bat, I have a very unconventional trading style. I want to make that very clear. I am not like anything you have ever seen before. The reason why the traditional way of trading is not made for most of traders. The reason for that is, as you can see, the trader who took this trade was right on the direction itself. It was going to the upside and it hit his take profit. But before that, he got stopped out. In the traditional way, you have to focus on price and the time. But in my way of trading, I only focus on the price and not the time. And I compensate for having a low risk to reward. It's okay going into drawdown for me. It's okay if the trade takes a few hours, maybe a day, but eventually I know that it will most likely hit take profit because my win rate is extremely high. Now here's a question for you. Would you like to wake up? You have just opened TradingView, look at the charts and know you're about to win that day, because this is going to give you the ability to do so. But before that, there's a few things that you have to combine to make it work even better. But the concept itself are relative equal highs and lows. So very simple, we have a swing high in here and we have a swing high in here. If we now draw a straight line from the original swing high all the way to the second swing high, that is a confirmed relative equal high. And the same goes for the downside. If we zoom in a little bit, we have a swing low in here and we have a bunch of different swing lows in here. If we now draw a straight line from the original swing low all the way to the next price action point, we see that the price has actually rated all of those relative equal lows. And the answer to that is liquidity. If you look at this price action chart, what do we see? Right from the start, we have a swing high in here, we have another swing high in here, and another one in here. Now, right away, when you look at this chart, what do you see? We have a swing high in here, we have another one in here, another one in here, and a bunch of different swing highs right in there. See this as a pool. And above this pool, there's a bunch of stop losses residing, basically liquidity that the market has to take in order to go in different directions. Essentially, it is a magnet onto the market, because the more liquidity is residing at a certain level, the more likely it is that it will hunt those liquidity points. And another thing that will greatly increase your chances of spotting great relative equal highs are when you have multiple swing highs aligning just like that. A confirmed relative equal high is when you have one swing high and another one. So you need two. But if you have more, that's even better. That confirms that you have even more stop losses above this certain level. And many people see this as resistance, but it's completely wrong. I see it the opposite way. We will trade higher into your stop losses in order to take profit out of the market. Now, a very common question that I get asked a lot of the times is, why did it not go to the upside or downside first? And to answer that question, we'll go on to the chart that we have just looked at. We have a swing low in here and another one in here. Confirmed relative equal lows. However, it has gone to the upside first. It did not do something like this immediately, right? It has gone to the upside. The reason for that is because this level are another relative equal highs. So it goes both ways. You have to be careful. It's not that if you see relative equal lows, okay, I'm going to take a sell. But you have to combine information the market is giving you. And bear with me, you will understand it because it's not that hard. People make rocket science out of it, even though it isn't. So we have a swing high in here. We have another swing high in here and a bunch of more swing highs in here. So what are those? Those are relative equal highs. But then again, it did not validate the relative equal highs first. It has gone down. And the reason for that is because, again, it goes both ways. We have a swing low in here. We have another swing low in here. If we now draw a straight line from the original point and extend it to the right, we can see that the relative equal lows got cleared first. Now, and here's the point where people will come up with some random solution in order to tell you why it has done that. But here's the very simple answer. The reason why it has gone for the relative equal lows first is because, as you can see, how many swing lows can you count? It's 1, 2. And before you say, well, what about those? Those don't count. The reason for that is because they are too far away. Again, they have to be relatively equal close to each other. And that is not relatively equal close to each other. But how many swing highs can we count? It's 1, 2, 3, and 4. Confirming that the relative equal highs are in control here. But then again, why did it go for the downside first? Because take this as a rule of thumb. Before the market has to go to the upside, it will go down first because it has to take fuels. Remember of the stop loss that we have just talked about? It takes your liquidity so it can go higher again. So if you have 4 to the upside, but only 2 to the downside, 4 is going to win. Now, understanding the concept is great, but the more important question is, how could I have made money out of this? Because at the end of the day, that is all that matters in trading. And there are multiple ways. I'll show you a couple of them. Remember, this chart was the chart that we have just seen, and we have relative equal lows residing right in here. We also have the relative equal highs. I have just explained to you why we will go to the relative equal lows first before we go to the relative equal highs. So that information alone is telling us that we will get an entry down in here because we know it will get hit first and then the relative equal highs will get hit. So again, since we know that the relative equal lows will get violated first, we simply take entry right in here because they already got taken out, aiming for the relative equal highs. But don't be too generous with your profit target. Always keep it very simple and don't shoot for the moon, guys. Now, and even if we miss the first opportunity that the market has given to us, use the second that presents itself. But let me be very clear with this. You should never force a trade. But you should never back off a trade if the market gives you another chance to enter. So again, looking at the chart, imagine we have missed that entire move. The market always pulls back, even though in that period of time, it was looking like we will just go into the upside forever until we take out the relative equal highs. No, the market always pulls back. Once you see down close candles, that is a time where you take a buy. Simple as that. But how can I be so sure that the relative equal highs will get hit? The answer to that is never back off from your original target. Always stick to the plan. You see, 99% of traders would have backed off right in here. You see, we have a swing high in here and a swing high in here. What are those? Relative equal highs. Most traders would have backed off because they have seen this big down candle. And that is why most traders lose money, because they are not able to stick to the original plan. Now let me put it in a different perspective. Every single trade that you take is a business decision that you've made. And here's a question for you. Would you do business with a partner that constantly changes their mind? Because I wouldn't. Now, obviously, the market is your partner in that sense. So you have to clearly understand this concept. The market won't pay you if it's guesswork. You have to be clear with the direction. You have to know and stick to the plan that you have originally made. That is the only way to succeed in this and have same results like me as a multiple six-figure funded prop firm trader. Then join the Discord in the description for free education, and I'll catch you in my upcoming mentorship.